Do US equities have what it takes to continue pushing higher? Hello and welcome back to our channel. My name is Daniela. And in today's video, we are going to be looking at US equities because they have been very strong lately, pushing through a bullish rally, but they've come to somewhat of a halt, seeing some bearish bias there in the short term. So we'll be looking at what's happened in the latest earnings season, but also how much further can they go. But before we get into it, please like this video, comment, subscribe, and turn on your notifications. As always, if you have any questions, then leave them down in the comment section and we'll try to get back to you as quickly as possible. So as I was saying, US equities have been pretty strong since the start of 2024. We've seen the bullish continuation that started back in November. Now, we know a lot of this came on the back of the Federal Reserve starting to talk about the end of rate hikes, talking about that normalization, stabilization of the monetary policy. And at some point, markets started to price in rate cuts, which would enable equities to see better valuations in the future. Now, the momentum has continued to surprise many, even when the stock market was showing clear signs of overbought or being overvalued. We still continue to see positive momentum. Now, a lot of it has come in from the big technology companies, the Magnificent Seven. We know they've attracted a lot of interest in the last 12, 14 months in markets, a lot of it driven by the AI craze. We know that NVIDIA has been one of the key drivers of this momentum, pushing equity markets higher. But a lot of questions, the sustainability of it, the breadth on the market has been very limited. They say it's been a few pulling or dragging the others along, and that is unsustainable in the long term. We've also got to consider monetary policy and what central banks are going to do. When are they actually going to start cutting? For now, it looks like the economy is more resilient than expected. But we have seen some data in the last few days. It isn't the busiest week on the calendar. There is an absence of catalysts this week. And that's why we're seeing a little bit of sideways consolidation and a bit of uncertainty for equity traders. But we did see yesterday, we saw some consumer confidence data, but also durable goods orders. They both came in worse than expected. Durable goods orders fell 6% in the month of January, more than the 5% anticipated. And if we're looking at consumer confidence, it fell to 106.7 in February, expected actually to come in at 114. So those two data points did come in worse than expected. We know that consumer spending is a big part of the US economy. So therefore, this weaker reading could potentially skew some of the expectations that the US economy is going to continue growing at a strong pace like it has been. In fact, this afternoon on Wednesday, we have another reading of the fourth quarter GDP. Remember, last time it came in at 3.3%. Not expecting to see much revision to that, but if we do, we could see potentially a little bit of momentum come back into the market. Remember, in the third quarter, actually grew 4.9%, when most economies around the world were actually growing 0%. So the US economy continues to stand out, continues to show good momentum. We'll also have PCE price index this afternoon. Again, that is a closely looked at data point because the central bank, the Federal Reserve, does regard it in its monetary policy decisions. PCE prices are expected to come in at 1.7% in the fourth quarter, which would be a drop from 2.6%. So we do have some data trickling in, but it isn't the busiest week in markets. One thing that we have just come out of is the earnings season, the fourth quarter earnings season. And we've seen mixed readings. Overall, it's been a positive season. We'll look at some charts now to see how we can sum up the reports. So let's kick it off with this chart of the earnings. You can see it's the S&P 500 earnings that have come above, in line, and below estimates in the fourth quarter. As you can see, the majority of the sectors have seen around 70 and 80% of the companies reporting better than expected earnings. In the information technology section, which is the first one here, 88% of companies reported above the estimates for the earnings season, we saw a similar momentum also in the energy sector, industrials and consumer staples all above 80, with healthcare closing off that category. Then the worst performing was actually real estate and financials. But overall, the earnings season, as I said, was somewhat mixed. I think financials were the big underperformers and saw a little bit of weakness in the stock market. But technology continues to drive the momentum higher. And these companies reporting higher than expected earnings has also strengthened the positive risk-on sentiment that we've seen in the stock market as of late. We can also look at the revenues. We've seen revenue surprises actually of around 3% in healthcare. If we're looking at the index as a whole, we're looking at around 1.2% surprise in terms of revenue. This isn't earnings, it's specifically revenue. 1% for the technology section. And again, financials around 0.4%. And in this case, energy and utilities have been the underperformers here in terms of expectations when it comes to revenues. So overall, as I said, a mixed season for earnings. We've seen some interesting momentum in markets. But let's quickly jump into the chart now to see what we are seeing, because you can see the S&P 500 here starting to consolidate sideways with a little bit of weakness there after the jump on Thursday last week. Now, a lot of the data that's come out recently has come in better than expected, despite the consumer confidence and the durable goods orders that we saw on Tuesday. The data up until now, when it comes to the labor market, when it comes to inflation, has come in above expectations, and that has consolidated the view of a stronger US economy. That, of course, pushes back on the need for rate cuts from the Federal Reserve. And in markets right now, it's all about pricing in when that first rate cut will be. The Federal Reserve seems to be pretty much that it will happen in the second half of the year. Right now, markets were pricing in when the year started around 625 basis point cuts, around 150 basis points of cuts in 2024. Now that has come down to under 4, and I wouldn't be surprised if it gets cut back even further. I'd say about 2 is probably correct. You could push it to 3 maybe if the data worsens significantly. But of course, markets need to adapt to all of this. So far, it's been interesting. We've seen a change in momentum in how markets receive data. Prior in the last year or 18 months, we've seen good data bad for the stock market. And that was basically because it allowed central banks to increase interest rates or to keep monetary policy restricted. And therefore, that was bad for stocks. There has been a shift in mentality in the last 4-6 weeks in markets. And I think the way the data has been priced in to markets has shown that, in the fact that markets or traders no longer see good data as bad for the stock market. In fact, good data is essentially good. It means the companies are performing well. It means the economy is performing well. It means the consumers are still holding on. And therefore, expected future valuations are good for companies if we expect these earnings to continue. And therefore, that should be positive for the stock market. It also has to do with the fact that markets are now pretty convinced that central banks, including the Federal Reserve, are going to start cutting rates this year, even if it is later than initially anticipated, or if there are many rate cuts than initially anticipated. But even if there's less rate cuts and they start later, markets are pretty certain that the Fed is going to start cutting in 2024. That, coupled with good data and essentially a soft landing, should be good for the stock market. So that is kind of the shift in mentality that we've seen. And that's why we've seen a continuation of this bullish pattern even throughout the new year. Something to watch out for is the RSI divergence, because as you can see here, we've seen higher highs in the stock market pretty much since the start of the year. But in terms of the RSI, we are seeing a little bit of a kind of change in what it's telling us in the story. As you can see here, we've seen higher highs in the RSI here in February, and we haven't actually quite managed to beat the high that we saw in February, which we did in the price. So we're seeing a divergence between RSI highs and price highs, and that essentially could be telling us a change in momentum in price. We could see some further weakness in the stock market, some further selling coming in. And that is, of course, something to watch out for. I quickly want to pull up another chart that's quite interesting. This one here, and it's one from Yahoo Finance, which is essentially talking about where they expect, or where many forecasters expect the S&P 500 to end the year. As you can see, many of them expect it to be above the 5,000 mark, which is recently just broken. Around 4 of them expect it to be below, JP Morgan being the most bearish at 4,200 points. That would be roughly around 800 points below where we are now. But the majority of them do have some positive views for the S&P 500 this year, suggesting that the momentum could continue. That doesn't mean that we don't see a correction in the meantime. Of course, in order to enable further bullish momentum and new buyers to come in, usually we need to see some sort of a pullback, which could be what we're facing right now, just kind of consolidating just below that 5,100 level. But the RSI, as I said, is starting to kind of point a little bit of a bearish finger at the stock market. Let's take a look quickly also at the Nasdaq, the US 100. Similar momentum. We've seen some strong bias here to the upside. Again, starting to stall, seeing a little bit of resistance. And also looking at the RSI, we're also seeing that divergence. You can see those lower highs in the RSI back from the 19th of December, followed by the mid-January and also the beginning of February, have actually translated into higher prices. Again, that divergence suggesting that as this RSI weakens, we could also see price turning, momentum turning and heading lower, even as we do have that positive momentum in the stock market. So all in all, questioning how much we have to go. The earnings season generally has given a positive bias to the stock market. The Federal Reserve continues to push back on rate cuts, but that doesn't seem to be affecting stock traders so much anymore. Data continues to come in strong, but the 2 data points that we have seen this week coming in below expectations could have potentially alerted some traders and potentially put further weight on upcoming data. Of course, March is going to be a very busy week on the calendar. We've got central bank meetings, we've got employment data, we've got CPI readings, and there's likely to be quite a bit of volatility. But for this week, we are consolidating, struggling to find that catalyst that will push the direction in the short term. That is it for today's analysis of US equities. Thank you so much for watching, and don't forget to subscribe to our channel.